Hello, my name is Fabian Degen. I am the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a meeting with me. We are open for business. So let's talk about our topic for this week's podcast, business owner divorce in New York. How to protect your equity, your cash flow, and your company. So for business owners, divorce introduces a level of complexity that most legal advice does not fully anticipate. The business is not just an asset on a balance sheet. It is the engine of the family's income, often the largest piece of the estate, and frequently the most illiquid. Dividing a business in divorce, or even dividing the value of a business while keeping the entity intact, requires a different set of tools than dividing, for example, a brokerage account. Valuations are contested, cash flow is scrutinized, future earnings are imputed and argued about, and the financial planning implications are bigger than they appear. A poorly structured settlement around a business can leave the owner liquidating equity to fund the settlement, taking on debt to cover the buyout, or seeing future business growth quietly diverted to fund maintenance. Whether you are the business owner or the spouse of one, the way the business is treated in a divorce will shape the rest of your financial life. This is where careful work matters most. The principles in this podcast apply across most kinds of closely held businesses. For example, professional practices, family businesses, technology companies, real estate operating partnership, and the like. The first analytical question is whether the business is marital property, separate property, or some combination. If the business was started during the marriage, it is generally marital. The question becomes one of valuation and division. If the business was started before the marriage, the premarital value is generally separate. But the appreciation during the marriage may be marital if either spouse contributed to the growth. Under New York domestic law 236, active appreciation, so that means appreciation produced by the effort of either spouse, is treated as marital, while passive appreciation, which means appreciation that would happen regardless of effort, is generally treated as separate. So distinguishing active from passive appreciation in a business is rarely simple. A forensic accountant can review revenue, profit margin, capital investments, and effort levels to make the determination. And the analysis often becomes one of the most contested issues in the case. So let's focus on business valuation. Business valuation in divorce is its own discipline. The basic methodologies like income approach, market approach, or asset approach are well established, but their application to a specific business requires judgment. And the judgment is where the spread happens. Two qualified valuators looking at the same business can arrive at material different numbers, particularly when the business is service-driven, owner-dependent, or growing. In many cases, each spouse retains their own valuator, and the two then debate methodologies, discount rates, owner compensation adjustments, and the appropriate treatment of personal goodwill. In other cases, the court appoints a neutral valuator, and each spouse may engage their own expert to review and critique the neutral's work. From a financial planning perspective, the most important thing is to understand the assumptions behind any valuation that is on the table. A valuation that looks quite high because it assumes the business will continue to grow at recent rates is a very different number from one that uses conservative forward assumptions. So let's focus on another critical distinction here: cash flow versus income. And this is one of the most common sources of disagreement in business owner divorces. Income, as reported on a tax return, is what the IRS sees. Cash flow in the divorce context is what the business actually generates and what the owner actually has available to live on. These can diverge significantly. A business may show modest taxable income because of depreciation, retained earnings, owner-paid personal expenses, or deferred billings. A forensic accountant analyzes the difference between the reported income and economic cash flow, and the cash flow figure often becomes the basis for support calculations. If you are a business owner, expect this analysis to happen. If you are the spouse of one, expect to need it. Let's talk about a buyout and how to structure this. So once a value is agreed on or ordered, the next question is how to deliver that value to the non-owner spouse without destroying the business in the process. Common structures include a lump sum cash payment, structured notes paid out over several years, an offset against other marital assets, or some combination of those. Each has its own trade-offs. A lump sum, for example, gives both sides certainty but may require the owner to borrow or to liquidate other assets. A structured note keeps cash in the business but leaves the non-owner spouse with credit risk against the business and the owner. An asset offset preserves liquidity for both sides, but only works if the rest of the estate is large enough to support it. So the right structure depends on the cash flow of the business, the rest of the marital estate, and the risk tolerance of both spouses. None of this is the attorney's specialty. So this is where a certified divorce financial analyst, CDFA, and a tax professional add the most direct value. Let's talk about the future earnings and the maximization argument. So business owners often see their reported income scrutinized for whether they are maximizing. The argument is that an owner can suppress income, for example, by deferring billing, declining contracts, or postponing growth, and that the court should impute a higher income for support purposes. This is a real argument, but it is also harder to win than it appears. Owners are generally allowed to make business decisions in good faith, and the court will look for evidence of deliberate suppression rather than ordinary judgment. On the other side, owners should be aware that significant year-over-year drops in reported income in the period leading up to and during a divorce will be scrutinized. Documentation of legitimate business reasons for the drop, market conditions, for example, lost contract or completed projects, is important. So from a planning perspective, the safest position is to operate the business consistently with how it has been operated historically and to document everything. Major strategic shifts in the middle of a divorce attract attention regardless of their merits. Let's talk about partners, operating agreements, and other stakeholders. So if you have a business with a partner, the divorce will not stay confined to just the two spouses. Operating agreement, shareholder agreements, and partnership agreements often have provisions that are triggered by an owner's divorce. Some agreements give other partners a right for first refusal. Others restrict transfers to a non-owner spouse. Some require the divorcee and some require the divorcing owner to notify the partnership or to provide certain documents. Even where the agreement is silent, partners are likely to have a strong interest in how your divorce affects the business. A buyout you structure to fund from business cash flow can have direct consequences for partners' distributions. Required document production can pull confidential information into court proceeding. If you own a business with other equity holders, the divorce strategy needs to be coordinated within the partnership context. This is often more complex than the divorce itself. So now, plan the business side as carefully as the personal side. Business owners in divorce often default to focusing on the personal financial picture and treating the business as a separate problem. That is the wrong frame. The business and the personal picture are connected, and decisions in one area shape the other. The most successful settlement for business owners are built with the same team that the rest of the financial picture demands. A divorce attorney, a certified divorce financial analyst, a CDFA, a forensic accountant or business appraiser, and a tax professional. They model the settlement through the business, not around you. If you own a business and the divorce is on the horizon, the earlier you start the planning, the better. The decision you make in the months before the case is filed often determine what is possible during the case itself. Let's focus on some frequently asked questions that I receive from my clients. So now, one question is, can my spouse force me to sell my business? In most cases, no. The court is generally more inclined to keep the business intact and structure a payout rather than force a sale that would destroy value. Forced sales do occur, but typically only when there is no other way to deliver the non-owner spouse share of the marital estate. Even then, the court has flexibility to order a delayed sale or a structure payout. Another question, will my spouse get half of my business? Not automatically. New York applies equitable distribution, which means the marital portion of the business value is divided fairly, considering a long list of factors. In many cases, the non-owner spouse receives less than half of the business marital value, particularly when the owner contributed all of the labor and management. The non-owner spouse may receive an offsetting share of other marital assets instead. What if I started the business before getting married? So the premarital value of the business is generally separate property. The appreciation during the marriage may be marital if it was driven by either spouse's active efforts. So distinguishing premarital value from marital appreciation requires forensic analysis, and the result often depends heavily on documentation. Old tax returns, financial statements, and capitalization records become critical evidence. How do I keep the divorce from disrupting my business operations? Well, plan ahead. Engage your own forensic accountant early so that document production can be handled efficiently. Coordinate with your divorce attorney on the timing of major business decisions. Communicate with key partners or stakeholders before they hear about the divorce from other sources. And operate the business consistently. Major strategic changes during a divorce will be scrutinized regardless of their merits. A controlled, planned process is dramatically less disruptive than a reactive one. This was this week's podcast, Don't Screw Up Divorce. My name is Fabian Degen. I'm the owner of FMD Wealth Advisors. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business.